There's two other situations where using transaction insurance can be really helpful on distressed deals. So one of them is where you have a buyer of assets from a distressed seller, and this is in a pre-bankruptcy situation. And the concern is around, is the buyer paying what's called reasonably equivalent value? And that's really important, because if that distressed seller later does petition and go into bankruptcy, then the debtor's creditors can seek to undo the transaction and say that buyer didn't pay, fair value, or what's called reasonably equivalent value. And so they can try to undo the transaction, alleging it's a fraudulent conveyance. So one type of policy that we've been able to get insurers to write is to protect against this fraudulent conveyance risk and make sure that the asset buyer, the pre-bankruptcy buyer of distressed assets, has protection in the event that the debtor's creditors at a later date allege that this deal was not for reasonably equivalent value, try to undo the deal or sue for damages in that event. So that's one that really helps deals get done, where you've got nervous buyers and you've got asset sellers that really need to get deals done because they're in a difficult cash position and they need to bring cash in by selling assets. The other situation is a risk that's called successor liability, and it's sort of similar and related in some ways, but it's different in the sense that where you're buying assets, and this could be out of a bankruptcy or could just be again from a distressed seller pre-bankruptcy, and there are known liabilities that are not being assumed by the asset buyer. They're being left behind with the seller, and they're not being assumed contractually. The concern is if that asset seller at a later time is unable to meet those liabilities, whether it's a claim or a future litigation or something else that comes up and they're unable to meet that asset buyer is deemed to have been a successor in interest to the asset seller. And there's a number of ways courts have imposed outside of the scope of the contract, where there's no assumption of liability in the sale contract for the sale of those assets. Courts have nonetheless used different theories and legal doctrines to impose successor liability on that asset buyer. And even though they think they've contracted around and not paid or discounted the price for those liabilities, those successor liabilities in the future, using insurance is a way that allows them to have comfort that when they're buying a business, they're not going to, without knowing it, and unintentionally inherit liabilities that they think they've left behind.